The United States, together with other Western countries, has been carrying out rounds of sanctions, targeting the oil market directly. Recently, the US intends to further escalate the sanctions, and even does not rule out sanctions against India and OPEC, making the international oil market volatility further amplified. But in fact, the United States really care about maintaining the status of the dollar rather than oil prices. Saudi Arabia has been making a lot of moves lately. Saudi Arabia has restored diplomatic relations with Iran under Chinese mediation, announced the establishment of a new national airline, and is preparing to sign a $35 billion aircraft procurement contract with Boeing. On energy trade, Saudi Arabia and oil exporters, including Russia, have rejected the US and Western price limit bills and issued tough warnings to the US and Europe. Saudi Energy Minister Salman threatened that Saudi Arabia would refuse to supply oil to rate-limiting countries if Saudi oil was subject to price limits, RIA Novosti reported in Moscow on March 15. Earlier, the US Senate introduced a bill against the OPEC organization. The bill, once passed, will be used by the United States to violate antitrust laws as a reason to file a lawsuit against oil-producing countries. The bill would also make it unlawful to jointly restrict oil extraction and set prices for oil. In an interview, Saudi Energy Minister Salman was asked for his views on the anti-OPEC bill and the caps on Russian oil prices. He said the anti-OPEC bill and the oil price cap are very different, but both have a similar impact on the global oil market, as they bring new risks to an already volatile energy situation and make the situation more ambiguous. Salman mentioned that the anti-OPEC bill fails to realize that OPEC Plus has succeeded in bringing stability and transparency to the global oil market, but the bill completely fails to take into account the importance of idle capacity and the ill effects of losing it on market stability. The anti-OPEC bill would cut investment in oil capacity and would cause serious disruptions to global energy supply and demand, and essentially all industries related to oil would feel these effects. On the issue of price caps, Salman stressed that if price restrictions are imposed on Saudi exports, Saudi Arabia will refuse to sell oil to any country that imposes restrictions and will further reduce oil production. And it can be expected that other oil exporters will adopt the same policy as Saudi Arabia. Now it seems that the US is very dissatisfied with the existing effect of the price restriction order. This month, the US Treasury Department has news that the G7 organization intends to adjust the price limit policy again. In the near future, however, the US side as well as the G7 alliance has not made any further clarification, making people a bit puzzled. At the same time, the US side has claimed that the current Russian crude oil prices are still operating within their control under the policy restrictions of the G7 alliance. In 2022, the US-led G7 alliance's oil price limit standard for Russia is $60 per barrel, and many countries in Europe and the US cannot cooperate with Russia beyond the price limit according to the price limit policy. To this day, the G7 alliance is trying to adjust the price limit step by step in order to better control the import and export of Russian oil. In fact, last month, the price limit was upgraded once, extending from crude oil to many Russian oil products, with diesel, gasoline, and other energy sources being limited to $100 per barrel, and other oil products being sanctioned by the price limit. In response to the G7's price limit policy against Russia, a Russian spokesman publicly shot back that the G7 hoped to penetrate the Russian oil market through price limits, but the price limit policy was just a punch in the cotton. Russia's bottom line comes from the global demand for crude oil. Even if Europe stops importing crude oil and related crude products from Russia, Russia can turn its market to Asia and easily find a replacement. Since last year, India has been stepping up its efforts to buy crude oil from Russia. Until recently, India claimed that its country did not participate in the price limit order. and therefore should not be subject to it. Since crude oil over $60 cannot be exported using Western transport and insurance services, Russia is now simply replacing them with its own fleet of ships and Russian companies providing the appropriate marine insurance when exporting crude oil to India. In this way, Russia not only secures revenue from crude oil exports, but also gains revenue from other services such as transportation and insurance. The US is most annoyed that India and Russia are no longer using the US dollar for oil trade settlement, which means that the petrodollar system, which has been operating for decades, is at risk of collapse. The move has also led other OPEC countries to start using non-dollar currencies for oil trade, with the Chinese yuan being a common option. The US media warned India and OPEC and suggested sanctions against them. In fact, the US media inadvertently revealed the truth. The US is unhappy with the impact of the dollar's status, not the effect of the price limit order. The dollar's bundle with oil has cemented its hegemony as a global payment currency, but now that position is being steadily eroded, and it is intolerable for the United States. Thus, the so-called war on crude oil can actually be seen as a decoupling battle between the dollar and oil. These news have affected crude oil prices, which fell more than 5% yesterday, from a high of $74.90 to a low of $70.78 for WTI. This is the first of several consecutive days of declines, with crude oil prices peaking at $80.90 last Tuesday, down more than $10 compared to yesterday. So, for now, the crude oil war is unlikely to come to fruition in the short term. The US is trying to check Russian crude oil prices and thus reduce Russian revenues. However, for OPEC+, the US is not concerned with high or low oil prices, but with the shaking of the dollar's hegemony. While the dollar has always been tied to oil, the fact that other countries are beginning to trade crude oil in non-dollar currencies means that the petrodollar system, which has worked for decades, is at risk of collapse. Therefore, the US is actually trying to control oil prices in order to preserve its own dollar hegemony. In recent times, there have been a series of risks in the US financial sector, with several well-known banks collapsing one after another. Due to the US financial risks, resulting in a drop in international crude oil prices, once the US debt thunderstorm, the US credit crisis, and the dollar-linked oil prices are afraid of further decline, which is unbearable for the Middle East oil exporters, want to maintain their own interests. Saudi Arabia and other countries can only refuse to be pinched by the United States. The Middle East has been renewed, but the United States will not sit back and watch the Middle East condensed into one piece. In order to restore influence, the United States may make some small means. Saudi Arabia and other countries should also do early to be on guard.